Have you ever watched your screen in disbelief as a stock you sold just days ago continues climbing 50%, 80%, even 150% higher, while you're sitting on the sidelines with nothing but regret and that nauseating feeling that you just let a life-changing trade slip through your fingers? Here's the brutal truth that keeps most traders stuck in mediocrity. It's not that they can't spot winning setups, they actually do that quite well. The real problem is they have absolutely no idea how to stay in those trades long enough to capture the moves that could actually change their financial reality. They're trading with one foot out the door, ready to run at the first sign of profit, and it's costing them everything. What I'm about to share with you today is the exact pattern that separates traders who make a living from the market from those who just donate their money to it month after month. This isn't about some complicated indicator system or mysterious algorithm that requires a PhD to understand. This is about recognizing one specific moment in price action that signals the beginning of something massive, and more importantly, having the framework to actually capitalize on it. Has this ever happened to you? You enter a trade with complete conviction. The setup looks perfect, everything aligns, and within days you're up 12%, maybe 15%. Then that voice starts whispering in your head, "Take it now, lock in the profit. What if it reverses tomorrow?" So you exit, feeling smart and disciplined. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Now, back to that trade you just exited. You check it the next week and it's up 40%. The following month, up 90%. 6 months later, it's tripled from where you bought it. You had it right from the beginning, but you walked away with crumbs while someone else captured the entire feast. This pattern repeats itself in trading rooms, forums, and brokerage accounts around the world every single day. Traders work incredibly hard to find good setups, they risk their capital, they deal with the stress and anxiety. But when it comes time to actually make meaningful money, they sabotage themselves by exiting far too early. They're playing checkers while the market is playing chess. What you're about to discover might surprise you about how simple this one pattern actually is once you understand what you're really looking at. It's been hiding in plain sight on your charts all along, quietly signaling the beginning of every major trend move that's ever happened in market history. Stay with me until the end, because the transformation isn't just about seeing the pattern. It's about understanding why most traders see it, but still fail to profit from it, and exactly what you need to do differently. The transformation in how you view price charts happens the moment you realize you're not just looking at random candles moving up and down. You're actually watching a conversation between two groups of market participants, and one of them has billions of dollars backing their decisions. When you see that powerful breakout candle with volume that's 2, 3, sometimes 4 times the normal average, you're not witnessing some technical coincidence. You're seeing institutional money making its entrance, and they're not tiptoeing in quietly. They're announcing their presence loud and clear for anyone who knows the language. Behind the scenes of every major market move that's ever happened, there's this same signature. The smart money has already done their homework, spent weeks or months analyzing financials, industry trends, competitive advantages, and when they finally commit capital, they can't hide their footprints. Those footprints show up as explosive volume combined with decisive price movement. And this pattern doesn't discriminate. It appears in stocks, it appears in forex pairs, in crypto markets, in futures contracts. The asset class changes, but the fundamental dynamic remains exactly the same because human psychology and institutional behavior are constants. Here's where the hidden truth becomes uncomfortable for most traders. Even when they correctly identify this pattern, even when they recognize institutional money flowing in, Even when every technical factor aligns perfectly and they enter the trade at the right moment, they still fail. Not because their analysis was wrong, not because the setup didn't work. They fail because when that position starts moving in their favor and profits begin accumulating in their account, something shifts in their psychology. That voice of doubt creeps in. The fear of losing what they've already gained becomes stronger than the desire for what they could still achieve. This mental battle is the real trading game that nobody talks about in the YouTube videos showing perfect entries and exits. The impact of this psychological trap cannot be overstated. You can be absolutely, undeniably correct about the direction of a move. You can time your entry beautifully, you can do everything right technically, and still walk away with just a fraction of what was available because your emotions hijacked your decisions at the critical moment. It's the most frustrating experience in trading because you know you had it right, but you couldn't stay in your own way long enough to let the market reward you properly. Now, I want to go even deeper into this topic and share with you the exact mindset shift that allows certain traders to overcome this barrier while others remain trapped in the same cycle for years. Type mindset over technique in the comments if you've ever experienced this internal struggle between knowing what you should do and actually being able to do it when real money is on the line. The revelation that completely changed my perspective on trading came from a place I didn't expect. I was analyzing the accounts of consistently profitable traders, not the ones posting screenshots on social media, but real professionals managing significant capital. What struck me wasn't their win rate or their technical analysis skills. It was how little they actually traded. While I was executing 30, 40 trades a month, burning through commissions and mental energy, these traders were making maybe 5 or 6 carefully selected trades over the same period, and their returns were multiples of mine. This discovery forced me to confront an uncomfortable truth about my own approach. I had confused activity with productivity. My brain craved that dopamine hit from placing trades, from seeing movement, from feeling like I was actively doing something. But the market doesn't reward effort or activity. It rewards patience combined with precision, and those are two very different things. The journey from constantly active trader to strategically patient trader feels counterintuitive because everything in our society conditions us to believe that more action equals better results. But in trading, that equation is completely inverted. Behind the scenes of every massive winning trade you've ever heard about, there's a story that nobody tells. The story of all the times that trader did absolutely nothing, the days, sometimes weeks, where they sat on their hands watching mediocre setups pass by, resisting the urge to jump in, waiting for that one moment when everything aligned perfectly. That's the hidden part of the success story that doesn't make for exciting content, but it's actually the most important part. Think about the impact this mindset shift creates in your trading results. Instead of spreading your focus across dozens of trades, diluting your attention and energy, you concentrate everything on a handful of high-probability setups. Your risk management becomes cleaner because you're not juggling multiple positions. Your emotional bandwidth stays intact because you're not dealing with constant decisions. And most importantly, when that perfect setup finally appears, you have the mental clarity and available capital to commit meaningfully to it. The transformation happens when you stop measuring your trading competence by how many trades you make and start measuring it by how selective you can be. Legendary traders throughout history, the ones who built generational wealth from the markets, they all understood this principle. They made their fortunes from a few exceptional moves, not from constant trading. One strong trend captured and held with discipline creates more wealth than 100 small wins combined. And this isn't theory or motivational speech. It's mathematical reality backed by decades of market data. Now, I want to go even deeper into this topic and show you exactly what these professional traders are looking at when they decide a setup is worth their capital and attention. Drop selective patience in the comments if this concept is starting to reshape how you think about your own trading approach. The distinction between being a speculator and being an investor might sound like semantic wordplay, but understanding this difference will fundamentally change how you approach these breakout trades. Investors marry their positions. They buy with the intention of holding through thick and thin, often for years, building a long-term portfolio based on fundamental value. That's a completely valid approach, but it's not what we're doing here. As speculators, we're dating these positions. We're committing to them while the relationship is healthy, while they're showing us the characteristics we want to see. And when those characteristics change, when the trend shows signs of exhaustion, we exit without attachment or regret. This mindset shift removes an enormous psychological burden that trips up so many traders. You don't need to predict that a stock will go to a specific price target. You don't need to know if it's going to double or triple or increase tenfold. That's not your job. Your job is recognizing when a stock is acting right, when it's demonstrating the strength and momentum that characterizes healthy trends, and staying with it as long as those characteristics persist. The market itself will tell you when it's time to leave. You just need to pay attention to what it's saying. If this resonates with you, subscribe to the channel. I'm constantly sharing insights on psychology and patterns that actually separate profitable traders from the rest. Behind the scenes of this approach is a profound revelation about how wealth is actually built through trading. Most traders operate under the assumption that consistency means making a steady stream of small wins. They target their 10%, maybe 15% gains, and they feel accomplished when they hit those numbers repeatedly. But here's the hidden truth they're missing. The real money, the life-changing profits, come from the outliers. They come from that one trade where instead of taking your typical 15% and walking away, you stay in the position and capture 100% move, or 200%, or more. The impact of this multiplier effect is almost impossible to overstate. If you make 10 trades in a year and 9 of them give you 15% each, that's excellent. But if that 10th trade, because you had the discipline to hold it through a major trend, gives you 150% return, that single position will account for more profit than all the other 9 combined. This isn't hypothetical mathematics. This is the documented reality of how professional traders build significant wealth. They understand that one exceptional trade held with discipline creates a compounding advantage that dozens of good trades simply cannot match. The transformation in your results doesn't come from trading more or finding better indicators. It comes from this willingness to let a winner run its full course. Most traders intellectually understand this concept, but when they're sitting on a 50% gain and watching normal market fluctuations, that voice starts whispering again. That's when the real test begins, and that's exactly where we need to shift our focus next. Type multiplier mindset in the comments if you're starting to see how one properly managed trend could change your entire year. When you're looking at your charts tonight, scanning for opportunities, there's a specific moment you need to train your eyes to recognize. It's not subtle. It's not hidden in complex indicator calculations. The breakthrough candle that signals the beginning of these major moves has a visual signature that's actually quite distinctive once you know what you're looking for. This candle is typically much longer than the average candle surrounding it, and it doesn't just inch past resistance, it forcefully breaks through it. But here's the critical detail that separates meaningful breakouts from false moves. This candle closes near its high, not somewhere in the middle or near the low. That close near the high demonstrates conviction, real committed buying rather than indecision or distribution. The journey of a stock leading up to this moment is equally important. Behind the scenes, there's usually been a period of base building, a consolidation phase where the stock has been quietly forming a foundation. Then suddenly, that decisive breakout candle appears, announcing to anyone paying attention that something fundamental has shifted in the supply and demand dynamics of this security. The sellers who were keeping the stock range bound have been overwhelmed, and buyers have taken control with authority. This isn't a tentative move or a false breakout that immediately reverses. This is a statement. But here's where most traders make a critical mistake in their analysis. They see that powerful breakout candle, they recognize the pattern, and they think that's enough information to make a decision. They're missing the secret ingredient that transforms a potential setup into a high-probability trade. Volume is the hidden truth that separates the professionals from the amateurs in reading these patterns. When you observe a breakout candle accompanied by volume, that's 200, 300, sometimes even 400% above the stock's normal trading volume. You're witnessing something that cannot be faked or easily manipulated. Volume represents actual transactions, real money changing hands, capital being deployed into a security. While price can be pushed around in the short term, especially in lower liquidity environments, volume reveals the genuine commitment behind the move. The impact of this distinction cannot be overstated. A breakout on light volume is just noise, probably a false signal that will reverse quickly. But a breakout on explosive volume is institutional money making its entrance. Those are the footprints of smart money that we discussed earlier, now visible and measurable on your chart. This revelation changes everything about how you evaluate potential trades. You're no longer guessing whether a breakout is legitimate. You're reading the evidence the market is providing. Price tells you what happened. Volume tells you how serious the market is about it. Together, they create a language that, once understood, gives you clarity in situations where other traders are paralyzed by uncertainty. Type "volume confirms" in the comments if you've started noticing this pattern on your own charts and recognizing the difference between breakouts that work and those that fail. The timing of your entry into these breakout trades creates one of those moments where hesitation costs you everything. But recklessness can be equally devastating. There's a sweet spot that exists in every major trend, and finding it requires balancing two competing needs. On one hand, you want confirmation that the breakout is legitimate, that it's not just going to immediately reverse and trap you. On the other hand, you don't want to wait so long that the move becomes obvious to everyone, and you're essentially chasing a train that's already left the station. The ideal entry window opens right after that breakout. Candle has confirmed itself by closing strongly above the resistance level, but crucially, before the larger trend has become apparent to the broader market. Think of it like this. When you're getting on a train right as it starts moving, you can step on smoothly with confidence. But if you wait until that train is at full speed and try to jump on, you're taking unnecessary risk and probably paying a much higher price for the ride. The transformation in your trading results comes from recognizing that perfect timing rarely feels comfortable in the moment. When you're entering at the optimal point, there's still some uncertainty, still some fear, and that discomfort is actually confirmation that you're early enough to capture the meaningful part of the move. Subscribe to make sure you catch the next part of this framework. I focus on what creates real results in trading, not just flashy tactics that don't work. Behind the scenes of every successful trade I've ever made using this pattern, there's been a risk management framework that protected me when I was wrong, while giving the position enough breathing room to work when I was right. This is where most traders sabotage themselves without even realizing it. They either use stops that are too tight, getting shaken out by normal market fluctuations, or they use no stops at all, exposing themselves to catastrophic losses. The hidden truth about professional trading is that it's not about avoiding losses entirely. It's about controlling losses surgically while letting winners run freely. The most elegant approach I've found is setting your stop loss based on the structure of the pattern itself, typically just below the breakout level or below the low of that breakout candle we discussed. This isn't an arbitrary decision based on some percentage you're comfortable losing or a dollar amount that fits your psychology. It's a mechanical placement that respects the market's own structure. If the price falls back below that breakout point, the pattern has failed, plain and simple. The premise of your trade is invalidated, and there's no reason to stay in the position hoping for a miracle. The impact of this disciplined approach extends far beyond just protecting your capital. When you know exactly where your exit is if you're wrong, it creates mental freedom. You're not sitting there watching every tick, wondering if you should get out, second-guessing your decision. You've already made the decision before entering, and now you can focus on managing the position if it works, rather than constantly questioning whether you should abandon it. Drop structure-based stops in the comments if you're ready to start placing your risk management based on what the market is showing you rather than what feels comfortable. There's another layer to this framework that separates sophisticated traders from those still operating with a beginner's mindset. Not every setup that meets your criteria deserves the same amount of your capital. This might sound obvious when stated plainly, but watch how most traders actually operate, and you'll see they treat every trade identically, risking the same percentage on mediocre setups as they do on absolutely pristine patterns. The transformation in your results happens when you start thinking proportionally about position sizing. When you encounter a breakout pattern that checks every single box, perfect consolidation before the move, explosive volume, confirmation, clean technical structure with no conflicting signals, that setup warrants a larger allocation of your trading capital. But when you find a setup that meets most of your criteria but has some minor imperfections, maybe the volume isn't quite as explosive as you'd like, or the consolidation wasn't as tight, you can still take the trade, but with a smaller position. This proportional approach creates a beautiful alignment between your confidence level and your capital commitment. The hidden truth behind this strategy is how it completely changes the psychological pressure you experience. When you're not betting the same amount on every single trade, regardless of quality, you remove that all-or-nothing mentality that creates so much stress. You're playing a more nuanced game where you're adjusting your exposure based on what the market is actually showing you, rather than forcing every opportunity into the same rigid framework. Behind the scenes of professional trading, operations, this is exactly how money is managed. Positions are scaled based on conviction, not treated uniformly. Now here's where the real test of your discipline begins. You've identified the perfect pattern, you've entered with appropriate position sizing, you've set your stop loss based on structure, and the trade immediately works. The stock surges 20, 30, maybe 40% in the first few days after your entry. Then it stops. Price begins moving sideways, forming what looks like a range, and days turn into a week, maybe 2 weeks of essentially no progress. This is the moment where most traders panic and exit, convinced the move is over. But what you're actually witnessing during these consolidation phases is the market taking a necessary breath before continuing its journey. These sideways movements aren't a sign of failure. They're a natural and healthy part of how sustainable trends develop. The impact of understanding this distinction cannot be overstated. Healthy consolidations typically form tight, controlled patterns, with volume decreasing as the days pass, like a spring coiling up and gathering energy. The price isn't making wild swings. It's digesting the previous move, allowing new buyers to enter at higher levels, building the foundation for the next leg up. Compare that to an actual trend reversal, which shows completely different characteristics. Reversals display expanding volatility, failed attempts to retest key levels, and increasing volume on down moves as sellers regain control. Learning to read these signals transforms your ability to hold positions through their full development, rather than getting shaken out during normal, healthy consolidation periods that are actually setting up the next significant move. Put holding through consolidation in the comments if you've been stopped out during these sideways phases only to watch the trend resume without you. There's something almost magical that happens when you start looking beyond a single time frame and begin seeing how different temporal perspectives tell the same story. Most traders anchor themselves to one chart, usually the daily, and they make all their decisions based on that limited view. But the revelation that transformed my approach was discovering how much more conviction you can have when multiple time frames align and confirm the same pattern simultaneously. When you spot a beautiful breakout candle on the daily chart and then zoom out to see that the weekly chart is also breaking through a major resistance level that's been holding for months, you're witnessing something profound. It's not just one time frame giving you a signal, it's multiple independent perspectives all saying the same thing at the same moment. The impact of this confluence cannot be overstated. Your probability of success increases dramatically because you're not just reading one dimension of market structure, you're seeing how daily movements fit into weekly trends, which themselves fit into monthly patterns. Behind the scenes of every major market move that develops into something truly significant, there's this harmonic alignment across time frames. It's like having several expert analysts all independently reaching the same conclusion without consulting each other. When the daily, weekly, and monthly charts are all showing breakout characteristics, you're positioned at the intersection of multiple forces, all pushing in the same direction. This doesn't guarantee success, nothing does in trading, but it dramatically shifts the odds in your favor in a way that single time frame analysis simply cannot match. But here's where we arrive at perhaps the most uncomfortable truth about capitalizing on these major trend moves. Even with perfect pattern recognition, even with multi-time frame confirmation, even with pristine entry timing and proper position sizing, most traders still fail to capture the full potential of these opportunities. They fail not because of technical deficiencies, but because they lack the one quality that ultimately separates consistently profitable traders from everyone else. Endurance. The biggest market moves don't reveal themselves over hours or days. They unfold across weeks, often months, in a rhythm of advances, pauses, and further advances. The journey of a significant trend is rarely a smooth, straight line upward. It's a series of steps forward, followed by moments of doubt, pullbacks that test your conviction, consolidations that challenge your patience. This is where your character as a trader is truly forged. When you're up 20% on a position and it suddenly pulls back 8%, that's when the crowd panics and exits. That's when inexperienced traders convince themselves the move is over and they should lock in whatever's left of their profits. But if you've done the work, if you understand the pattern structure, if you've confirmed the setup across multiple time frames and established proper risk management, those pullbacks are nothing more than normal fluctuations within a healthy trend. The transformation happens when you develop the mental fortitude to maintain your position through these uncomfortable moments while others around you are being shaken out. Type endurance over everything in the comments if you recognize this as the real challenge you're facing in your trading journey. If you've made it this far, you're clearly serious about making a real shift in how you approach the markets. Most people click away after the first minute looking for quick fixes and magic indicators. The fact that you're still here tells me you understand that real transformation in trading comes from mastering the fundamentals of psychology and pattern recognition, not from some secret formula that doesn't exist. I put these videos together because I genuinely believe this perspective on trading, focusing on quality over quantity and having the endurance to let winners run, can change your entire relationship with the markets. If this resonated with you and you want to keep developing this approach, subscribing to the channel, make sure you don't miss the next piece of the puzzle. I'm constantly breaking down these psychological and technical concepts that separate professionals from the crowd. Drop pattern and patience in the comments if you made it all the way through and something clicked for you today. I read every comment, and it helps me understand what's connecting with traders who are on this same journey toward consistent profitability. If this breakdown gave you a new lens to view your charts through, hitting that like button lets me know this style of content is valuable to you. It's how I gauge what's actually helping versus what's just noise. There's a video right here about managing your emotions during drawdowns that pairs perfectly with what we just covered. Since we talked about endurance and holding through consolidations, that next video gives you the mental frameworks to stay confident when positions test your resolve. Click and continue with me over there. I think you'll find it connects these dots even further. Until then, remember that the market rewards patience more than it rewards perfection. Trade well.